Good morning, good afternoon. Welcome to Develop Your Edge with Anthony Crudele. I'm your host, Tom Schneider, CMT with NinjaTrader. And before we get into today's good stuff, I do want to remind everybody that futures and options trading contains substantial risk, is not for every trader. You could potentially lose all or even more than all of your initial investment. That's why we recommend you use risk capital. What is risk capital? It's money you can afford to lose. Doesn't keep you up at night, doesn't extend your retirement horizon. I also want to remind everybody that past performance is not necessarily indicative of future results. And what we talk about here today in this program contains neither trade recommendations nor financial advice and should be used solely for educational purposes. And with that, I like to welcome Anthony Crudele. How you doing, Anthony?
Good morning, everybody. Good morning, Tom.
How's it going where you are?
I have a hoodie on today, so it's a little cooler than normal. I think it's going to be in the mid 70s. I I need a hoodie for that now.
I was gonna say you might have to put on a sweater tonight. Dips in the 60s, you put in a sweater. Oh yeah, we get a little bit of we've got sunshine, but it's cold here, and that's kind of typical for November. But it was a pretty big week this week. We had a big number on Tuesday, kind of a little bit surprising to me, and not really surprising how the market reacted. PPI was out on Tuesday and was a little bit lower than expected.
Yeah, we keep seeing more headlines come out, more data coming out that potentially the Fed is going to be sooner than later pausing raising interest rates, right? And so everyone just keeps chasing these rallies higher. But I think the one thing is that the Fed is committed to getting interest rates to what they say 2%, right? Between uh, and right now it's just they're not going to stop until that happens. And I think that the fact that everyone just keeps chasing these rallies in what is still a bear market is why we keep seeing these pullbacks as steep as they are, as fast as they are, is because everyone gets caught long and no one wants to get caught holding the bag when they start to come off, and then to be honest with you, you take all that aside, it's November, it's the end of a bear market year. How often in history, I don't know the stat, but I've traded through many of them, does a bear market come all the way back or even halfway back or to the year and close pretty strong on a relative basis? I've never really seen that happen. Most of the time they're going to close near the lows of the year just because that's just been the tone for the year. And then you get these people at the end of the year that really are starting to chase a little bit with that FOMO. A lot of the stock traders, not us futures traders who are more geared towards the day trading side of things, but a lot of the stock traders are going to be chasing those ones that have been really beat down. And if they don't catch that rally perfectly and they buy them near the highs of the move, they rotate right out of them again. And it's just the same story. And so I think that, one of the things I want to talk about today is environment, um, and why it's so important on identifying environment and for the day. Because right now I don't think that you can look at, you could get really spun around from one day with this Fed, the Fed's going to do this, or you're thinking all macro, and then you sit down and you're really a technical trader, and next thing you know, you feel like, wow, I got to catch this rally, and you're just getting way away from what it is you're doing. So I'm going to go over some things today that I think are extremely important in identifying what the day is.
Well, and that's you make a good point. It's when you get pulled away from your plan or pulled away from your regimen based on what the news is talking about, what the talking heads are talking about because of these numbers. And while they're important to know when you're trading, especially if you trade after or before regular market hours, after regular market hours, there are some events that you need to know about and that the market might react, but it's easy to get caught up in the hype, I guess.
Yeah, exactly. I mean, and let's face it, right after the data comes out, the market's already looking forward again. So the market's always pricing the next thing in, right? So some of the data that's surprising, obviously, it's trying to price it in as fast as possible. And that goes back to, like, even last week when we were talking about it, you can't even click in on these days. These CPI, PPI, unemployment numbers. I used to trade them all the time. I don't even look to trade them anymore. You have to let the dust settle because the algos are pricing in whatever the headline is so fast that it's like the edge is gone. Your edge is gone unless if the news is so surprising, so shocking that it's going to go, 200-300 points in the S&P like it did really for the CPI that one time. But you take that one kind of day out of it, the rest of it is you're just chasing your tail. You're never going to beat them at that game, right? So I look at it and say, let the dust settle. Let the technicals show us what it is. You understand the theme, what's happening on the macro side. You don't have to be a macro trader. I'm definitely not a macro person. But I look at it to understand the environment, and I take that to the technical side of things, and I try to find an edge there.
No, that makes sense. That makes sense. So, with given all of that, what are you seeing today?
So let's go to the charts because that's what I need to be able to look at everything and identify what the environment is. And you guys have all heard me on NinjaTrader's channel talk about how I use Bollinger Bands and how it's really my favorite indicator. It's my number one indicator for identifying environment. And the time frame is extremely important, right? Even if we're day traders, we still need to have this little bit of a wider perspective of what's happening, right? You can't be too wide and you can't be too short in your time frame, right? Because if you're too short in your time frame and you're just trying to make ticks, I think that's a difficult game because you're just going to get churned a lot of times, especially when the market gets really busy like it is now and just flipping through prices. And if you get too wide in futures markets, your stops can be too wide, and then you're trying to figure out how can I manage this position. So you look at it, and you have to look at it, I think, in kind of that middle time frame to really identify the environment. So my favorite time frame for environment is 60-minute because it's an hourly basis, right? So you look at what's the market doing per hour on each bar. And then I put the Bollinger Bands up there and I use 20 period, 3 standard deviation. So I'll pull that up. You could see that 20 period, 3 standard deviation. I have an update on each tick. And I just use the top and bottom Bollinger Bands. I don't use the middle Bollinger Band. Probably heard me talk about this before. That would just be 20 period moving average. I just put in a 10 period moving average, and I use that on all my time frames, daily, 60-minute, 3-minute. I just like the 10 period. It just fits well in what I'm looking at, right? So this is my basic day trading. What direction do I want to be in chart? Okay. Now, other times you guys have heard me talk about dailies and all that stuff, but the daily doesn't change as much. Like the 60-minute is almost going to change every day on what the environment is, where the daily is not going to change every day. It's going to change probably weekly or even monthly sometimes because it takes time to work through it. So the 60-minute is like that time frame, my favorite time frame to determine what my day trading is going to be like. I also have an RSI in here, and the reason why I like the RSI is because on this time frame, on that hourly time frame, are we overbought? Are we oversold? Right? 70 or higher is overbought, 30 or lower is oversold. You can see this morning we're coming from an oversold condition. And the other thing I'm going to talk about with the Bollinger Bands is every time that the Bollinger Bands mouths are open, so you see the top Bollinger Band pointing up, you see the bottom Bollinger Band pointing down. Anytime that mouth is open, that tells me that volatility is expanding. And most people I know have learned to where, hey, this Bollinger Band is pointing down. We go down and hit the Bollinger Band. They might use that as support, and they might buy it for rallies. And if you look here, you probably had some minimal success with that, but the trend just continues to be down, right? So a lot of people will say buy off of that Bollinger Band that would maybe be an oversold thing, and maybe you look at that on RSI. I don't look at it that way. When that bottom Bollinger Band is open and that top Bollinger Band is open and we're going down, my strategy tells me only be short. Do not look at any longs. I don't even want to look at a long. I don't care if it gets 20 handles below that Bollinger Band. I don't care because right now I'm fading this hourly trend because it's going down and I don't want to go against it. Anytime Bollinger Bands are in a hurry to get open up that mouth, it tells me don't be in a hurry to fade the direction that the market's going with that opening of the mouth. So that is the basic thing that I look at, and we'll expand a little bit more. I don't know if maybe you want to talk from here, maybe any questions about what I mentioned.
Right. So, that's a great point. My question would be, you're looking at this at the beginning of the day, or are you referring to the 60-minute throughout the day?
Yes. The 60-minute. So I really only keep up two charts on all day long. I keep up a 60-minute and I keep up a 3-minute. Those are the two time frames I like. And the reason I keep the 60-minute up all day. And so this takes me into like, okay, all of a sudden, how do I know to stop being short? And I know that because once these Bollinger Bands start to come back in and they're saying, hey, guess what? I want to start coming back in. Then I think that the market is potentially done going in this direction. Volatility's stopped expanding. And now we might revert back in. So now you're looking at a mean reversion type trade. So how do I determine that? So I keep this up all the time, and it's a Fibonacci retracement tool. And I have 70%, 50%, 30%. And once these Bollinger Bands start to come back in and they make two peaks, okay, then once we establish above that 30% line, then I look for them to retest the 50% line. So instead of looking at a fib retracement of the price action, I'm looking at the fib retracement of the volatility. So that's using the Bollinger Bands. So for example, if I just go back and I take you over to where we were back here, and this is going to show you what I'm looking for potentially for today, right? So that actually would be right there. So this is the perfect example of something where the market skyrocketed higher, right? And you could see that. And once we started to fail to hold above 70% right there, okay, and I can even expand this a little bit wider so you can see it, right? That 70% line is my resistance, okay, because it's the peak of the Bollinger Band there, the peak of the Bollinger Band there. And this is the E-mini S&P chart. So this was an area I said, if it can't get above there, I am going to be bearish. And it's going to go down and test the 50%, potentially the 30%. So this 70 to 30% area is my boxed in mean reversion area. The 50% line I only use for covers. I never use it for entries. The 30% and 70% are my boxed in areas. So I look for shorts there. I look for longs there. Now there's two ways to trade this. One is, let's bring this back to where we are over here. Okay. There's two ways to trade it. One is I'll trade it just on the 60-minute. And a lot of times I'll use micros for this because it's going to be a swing position type trade and it may not get the 50% within a few minutes. It might take a few hours and sometimes it might take a day or so. Depends on how wide that volatility is. And my stop is just going to be an equal 1-to-1 from 70% to 50%. So wherever I get in, let's just say today it would be 4,000 or it'd be 39.88 to 39.62. That's roughly about what we'd be guessing it would look like, right? Or actually, we should go down to the 30%. It would be 39.36 to 39.62. So you're looking at roughly 26 points of risk or 26 points of profit potential if it holds above it. So my risk is usually going to be around 26 points, right? I might even take that down a little bit. Most of the time I actually will. And what I'll do is I'll put that stop in to give me a little bit better than 1R, equal risk to reward. Because now I'm really leaning on this level to hold. But I definitely don't want to risk more than what my potential is. And so I'll just trim that stop or carry that stop forward to eventually look to trade the 50% line. That's one intraday way to look at it if I want to be, bullish off of holding that 30% line. Does that make sense?
Sure. And would you wait? You're not using this as a breakout trade. You're waiting to get up above that 30%, right? And seeing that 30% hold as support before you decide I want to go long.
Yes. That's why a lot of times I might not get in exactly at 39.36. So I'll develop a range of execution around it, right? There will come a point to where if it gets too far above it, I won't buy it, which is why I like this 10-period moving average. Like in a perfect world, I'd love to see this moving average come down and maybe start to flatten out here and then stabilize above it. And then I can maybe have a really, really tight stop. And I'll say, look, maybe I'll put this 5 points below that 10-period moving average. And I'll try to stay long up to the 39.62. So I'll make a really tighter stop. Right now, I don't have anything really to lean on down in here because it could easily be very whippy. But as long as those Bollinger Bands are pointing in, I still want to be long, which is why I'll use micros for more of a swing type position. But that's the mental framework I'm in. I'm just waiting for that one thing. Everybody talks about being patient all the time, right? Well, be patient, be patient. Well, you got to know what you're waiting for in order to be patient, right? It's really one of those broad statements that everyone's like, well, be patient and all this stuff. Well, I know exactly what I'm waiting for. If this market starts to see these Bollinger Bands start to come back in and point in, then I would look for longs. Until then, that's not happening. On my intraday strategy, I'm only going to probably look for shorts because right now volatility is still expanding. That bottom Bollinger Band keeps pointing straight down, and that top one keeps pointing straight up. Until I see them boxed in, I don't look for mean reversion trades. Market is bearish to me.
Right. It's the difference between anticipating and using the evidence at hand. The evidence at hand says, hey, this volatility is still expanding. We don't have any evidence that the bands are closing, that mouth is closing. So let's still go with that. But you're anticipating, the anticipation is if it does turn up, then we are looking for a box in trade, mean reversion trade when we get there. We're not there yet.
Yeah, if you try to be the first person in to try and pick a bottom, especially in a bear market, most of the time you're the one that gets squeezed out, causes that wick lower on the stops. Eventually it starts to rally, then you don't want to buy it because you were so early, and then all of a sudden it rallies further than you think. I mean, we've all been there. That's why I developed this type of strategy, because I would be the guy, oh, that low is in, let me try and buy off of here. And it might have worked for a little bit, but then all of a sudden maybe I get run over again. But I probably got run over 10 other times, and it's death by 1,000 cuts trying to buy it. When the reality is the market has said, we are not ready to go higher yet. It's just not happening. So on this time frame, I would have essentially no setup. I'd only be looking at shorts. So what do? I can't really get short off this 60-minute setup because unless I want to lean off of this moving average, it's very difficult because it's too wide. I don't have targets. So that's when I'll take it down to a 3-minute chart. And on my 3-minute chart, I break it down to the one thing you've probably, everyone here, if you've watched me before, is the one thing I talk about the most. My favorite day trading type strategy is 3-minute bar. I have order flow cumulative delta, and I have an order flow anchored VWAP. I can go over these settings, but I'm going to go over them each and every week. I would definitely say go back to previous videos where I explain these very clearly as to how I'm using them. But for today, I just want to show you that I'm using the order flow anchored VWAP. It's starting at the regular trading hours on the opening 3-minute bar. And I just use that order flow cumulative delta down here, which is going to show you what's net bought and sold on the bid and offer. So if there's 500 on the offer, 500 on the bid, and somebody goes to the market and buys 250 on the offer and then sells 100 on the bid, it's going to show net positive 150 on the cumulative delta because they bought more. The market has bought more on the offer than has been sold on the bid. So you can see here this morning we're negative 6,600, which means there was 6,600 more sold on the bid than bought on the offer. Okay. So this also, when I come in and I look at this, I go, okay, they're selling it. People are selling the market. Why do I want to be in a hurry to be long? I don't. Right. And now I have my 3-minute opening range bar. And then, so it's the regular trading hour bar, and I box that out. I'm very visual with all this stuff. It's so important to me. So I take the 3-minute opening range high and the 3-minute opening range low, and I box them in. And then I have this order flow VWAP. And as long as that order flow VWAP stays within this range, I am at no direction. So I have 60-minute bearish, possibly could turn bullish at some point. We'll have to wait and see. But the cumulative delta is telling me I want to be bearish. So it's telling me to be short. Then you have this order flow VWAP inside the opening 3-minute range, and it's telling me that we're probably just going to chop around and we're going to be just in a choppy range day. So I am at this point, so I'm bearish and then really no trade. So I just don't have any setups at this current point.
And anticipating, where you might get a setup, where you might get a trade, are you looking to extend past that opening range low? If we were to, you see that low at, I think it's 39.16 roughly, right above that second standard deviation band below the VWAP. Is that an area that would give you an indication that you should go short? Where are we? Where are we looking?
Yeah, that's a great question. So the reality is the only way I can go short today in the S&P, the only way would be is if this order flow VWAP were to start to get below the opening range. Then I would be like, you know what, this thing could really get hammered because I have multiple confirmations on multiple time frames. I'd have bearish cumulative delta, opening range breakout with the order flow VWAP below. See, once again, a lot of people will say, look at the opening range high and low. If it gets above it, be long. If it gets below it, be short. But look at today. This is a perfect example as to why I don't do that. It gets above it. Oh, we're going to rally. Boom, right back into it. Oh, we broke the opening range low. Let's get short. Boom, new high. Oh, now we're going to go higher. Boom, we're back in the middle.
Right.
And the whole time I'm looking at it going, the volume weighted average price has told me that there's no really buyers on rallies. There's no real sellers on breaks. And look at cumulative delta is right where it started the day. People, this is why it's so important to, so a lot of people will say just follow price, but if you don't have volume attached to it to see what they're actually doing, because sometimes the markets could just drift away in price, and all of a sudden you could get this, like I said, this FOMO where you're like, oh, they're going to rally now or they're going to break. But if you don't have the volume following it and you don't have that other time frame confirming it, you're just going to chase your tail. I mean, these are the types of days where I see most traders get really chopped up. Well, I'm long. Now I'm short. Well, now I don't know what to do. And now all of a sudden they're just what we used to call the toilet bowl when we were in the pit, and you're just in there and you're just, and that's tough. Look, and I can laugh about it because I've done it a million times, but I look at this day and go, if I would have had this order flow VWAP below the opening range low, I'd be short. I'd be short full positions because this thing could get cracked. It's not the case.
And so as we look at the order flow VWAP, and let's say being that it's up towards the top of the opening range, right? It's very close to the opening range. Let's say this market does turn around. We do see a rally that brings it above, then you might be long.
Yeah.
And there might be confirmation on the 60-minute chart as well, because if we do see a rally, that should pull those Bollinger Bands together. Maybe not in this next candle, but maybe if we see a continual sideways to uptrend, we might see those bands get closer together and start closing.
Yeah.
Because that is the definition, right? It's volatility based. So if there's sideways action, there's less volatility. It's going to close together.
Exactly.
But really, the 3-minute is where you're going to actually take you're going to make your decisions from.
Yes. Well, so what will happen? Let's just say today everyone goes, well, you know what? Maybe the market could flush out this morning, and maybe if you want to look for a late day rally. And here's the way I would look at it. Let's see what it does here. If all of a sudden these Bollinger Bands close, and then you were to go to your 3-minute and see the 3-minute get above that opening range high, then I would be in a long position. And then I would have targets way up top going back to here, wherever that 50-minute, that 50% line is, right? So I'll use a combination of the two of them. But I want to actually go to the NASDAQ because the NASDAQ today actually showed me something that was a little bit different. It actually looks a little different now than it did this morning. So one of the things I did, let me go to my Fibonacci retracements here. This morning in the NASDAQ, you can't tell now, but the NASDAQ was starting to get flat here and flat there. So when I was looking at it, I was saying, okay, maybe the NASDAQ is getting ripe for a rally because it was starting to get flat on the Bollinger Bands. That has since changed. And actually what I'm going to do is when I go to the Bollinger Bands here, I'm going to change, once again, my settings. So I have my 7 price levels. Move that over here so I could see it. I don't want to keep that visible. I want to take this to 30. And I'm going to do that. And I'm going to keep that there. And I'm going to make this one 70 real quick. Oh, which one do I want? One visible. This one, no. Click OK and click apply. Here we go. So now I have my 30, 50% here in NASDAQ. So this morning, what was interesting is this bottom Bollinger Band at that point was starting to rotate flat, and same with it here. And since we started to come back down, it's starting to open up again. So let's just take a look at the NASDAQ because I know we're running short on time. But look at the difference in the NASDAQ today. So I actually told you guys before I came on air, I actually got long NASDAQ this morning on this play right here. Okay. I got long when we started to get above in here, took some off, added some, I actually got stopped out on some, bought some back. And then I told you guys I covered them before we came in because I don't want to be on here while I'm long NASDAQ. It was a little bumpy, and it was, once again, it's not super easy and clean because the way the 60-minute looks. So I was keeping really tight stops. and I was using stops below the this 1 standard deviation below it. So let me quickly explain this. Opening range in the 3-minute in the NASDAQ was the low of the day. We break out to the upside. The order flow VWAP gets above it. I stepped in and got long right here. Okay. I put my stops below the 1 standard deviation, and I was using 2 standard deviation and 1 standard deviation as covers, right? So long here, cover, buy back in at the VWAP, stop below the order flow or the standard 1 deviation, out, back above the VWAP, long, stop below the 1 standard deviation, cover, right? That's the way I play it in those particular situations, because I've got massive amount of upside, and I'm just going to use 1 standard deviation stop below the VWAP and use the VWAP as my guide for my longs, right? And then exactly, you could see here, like I said, here I got nicked out on one of them, but the other 2 held. So that's what I would look at when those Bollinger Bands were coming in. See, now that the Bollinger Bands are widening out again, now I look at this and go, this is a bad trade here, because now we could come all the way back to this opening range. You know, I'm not saying it's going to happen, but now my risk is just getting too high. I mean, now I got to buy 11.6 12s and risk 11.5, 87s to sell 640s. And I think that now that like it's kind of played out, I would love to see the VWAP stay above there, the order flow bands or the Bollinger Bands start to come back in, and then maybe I would look to buy off of a 1 standard deviation later if that were to happen. And you can see a cumulative delta is also getting back hit to the short side. Actually, a lot of cumulative delta to the short side of the NASDAQ. It's quite a bit, which in some ways could mean there could be a squeeze later. But anyway, I know I kind of rushed through that, but I wanted to show you that because that's what I traded this morning was the NASDAQ, because that order flow VWAP got outside of the opening range, and I saw those Bollinger Bands potentially trying to come in. So I actually got in a little bit sooner with the NASDAQ before that set up. So that's why I did that.
Great. We are running up against time. I think we do have one order of business to take care of, though, Anthony.
We got the SDYE, and we'll talk about the CME Fed Watch tool, which I want to as well. But maybe what do you guys want to do first?
Let's take care of the question of the week. I think you might have answered some of it already, but let's take a look if we can put that up there.
My man Cheeto Hunter.
Cheeto Hunter, right. So Cheeto Hunter, I don't know. I can't see this too great. Let me see if I can bring that up. Bear with me one moment.
Your favorite setup and time frames to trade. Yeah.
So
let's go over that real quick, right? I mean, we basically went over that today. My favorite setup is it's actually going to be a mean reversion setup, and the mean reversion setup would be when the market's exhausted to one direction, okay, and you have that 60-minute Bollinger Bands when they start to come back in, and then you have an opening range low or high depending on the direction, and that order flow VWAP gets above that opening 3-minute high or low, because that's when you're just going to see the squeeze. One of the things I've learned is that when trends are powerful in one direction and you really try to catch in and get them, I'll trade small in that direction. But then all of a sudden, when you finally have established an area where you could see that massive mean reversion move, is when those 60-minute lines come in and start to point in. And then you also have the situations where you have opening 3-minute range and order flow VWAP starts to prove to you that could happen. That's when I've caught some massive trades, because you could feel the squeezes on. One of the things I learned in the pit was find where more people are wrong, and that's where you're going to get the fastest moves. That's a lot of times why you see big down moves in bear markets, and even big up moves in bear markets, because people get trapped and those moves can be fierce. That's why I actually like mean reversion trades that set up on the 60-minute, but then are confirmed on the 3-minute.
Great answer there. And Cheeto Hunter, if you send us a DM at NinjaTrader, we would be happy to send you something for contributing with that tweet.
Yeah, and last thing before we go, I mean, right now, I just wanted to mention this. Everybody is talking about what the Fed is going to do in the next meeting. And my favorite tool, my only tool that I go and use when it comes to what's going to happen at the next Fed meeting is CME's Fed Watch tool. And you could actually just Google CME Fed Watch tool. It'll take you to this place. And this will tell you where the money is being put on what's going to happen in the next Fed meeting. You can see that it looks like it's going to be 425 to 450 basis points. That's what the rate will be. It's an 80.6%. So you can see they're really, really strongly pricing in that for the next meeting. And that this really gives you the actual facts of what they expect to happen versus what you may think is going to happen, right? As you can see, it's only 19.4% chance that we go to 450 to 475 basis points. It's 4.5%, 4.75% in the Fed fund. So to me, this is just an awesome tool. And you could see, if you went back and looked at this before CPI and PPI, this was 50% each. And maybe it was like 55%, a little heavier weighted here, but you could see on how that's changed. And that's so important because it sets up what the expectations are for the market. So you could just, once again, go to cmegroup.com and search for it there, or go to Google or whatever you use to search and search for CME Group FedWatch tool. It's an awesome tool. I pretty much every major macro person I know and all of their letters is always leaning on the CME FedWatch tool.
Yeah, great tool. We use it in the bookend shows for sure. Yeah, it's that and the probability calculator, the matrix, really interesting because like you said, it's real. It's what the market thinks will be happening rather than talking heads. So
exactly.
Good stuff there. Anthony, we are hitting up against time, so I do want to say thank you very much again. How can people reach you?
Just add Anthony Crudele on Twitter and anthonycrudele.com. You find everything there. And don't forget to also check out placeyourtrades.com. Got a bunch of cool stuff there talking about event contracts if that interests anybody.
Awesome. Thanks so much, Anthony. We'll do this again next week. Thank you to the viewers for coming, and hopefully you can send us some questions on Twitter. Use the hashtag AskDYE and at NinjaTrader in the tweet, and we will consider them for future shows. In the meantime, everybody have a great trading week, and we'll see you next Thursday.
See ya.